So there's a few people showing up. I do have to apologize. I didn't remind everybody yesterday. It kind of slipped my mind. So I don't know how many people we're going to get. Saturday stream, there might be people that are busy with other things. And I probably should have sent out something yesterday during market hours to kind of remind people that this is happening. But remember, I do want to try to do them at different times just so we can include more people. I think next week I'll try to do one in the evening, see how many people show up for that. Yeah, so as long as there's a couple of people asking questions, it's fine. So this is VTS stuff only. No limits on what you can ask me. It can be anything, of course, but just VTS community members here. So any questions you have about emails, the strategies, whatever, let's just see what comes up. We'll see how many questions we can get. All right, on the vol trend. When you did the trade early Tuesday, the price was around 24 cents. I think I got 21 for the naked and 20 for the spread. At the end of the day, when I made the trade, it was at 14. I think it was at 16.50 at the end of the day. So you might have got a bad fill price. But the general point of the question, let me see if there's a follow-up. These seem like huge swings. Is there a lower limit to making this trade when you publish it? Well, of course, I can't see the future, right? I have no idea what's going to happen over the next 3 hours. It was just as likely, I would say 50-50, that you would have gotten a better price than when I did it live during that live stream. When I got 21 cents and it goes down to 16 at the end of the day, could have easily gone to 26 the other way, and mine would have been the worst price of the day. So on a dated, like an intraday basis, of course, none of us have any predictive power whatsoever. I think it's probably good to keep that in mind, that it's really 50-50. So in that sense, no. There's no lower limits, there's nothing. If you're selling the 11.50, for example, and you get 21 cents versus 14 cents, as long as it's over, say, a penny and a half, the trade is technically worth taking, because right around a penny and a half should be clearing your trade fees and, just bid-ask spreads and whatnot. Anything above that is going to be worth taking. So again, we're going to be cycling so many of these trades through that really the difference between intraday swings, in the long run, it will work out about the same for everybody. It really will. It doesn't matter what time of day you're executing. If you do a consistent time, or even if you're just random, it's all 50-50. It's just, it sounds to me like in this case, yeah, that day when I sent it out, at the moment that I sent out the trade, I think it was even higher than 21 cents. But when I did the live stream, I thought people might want to see it live, so I went ahead and executed it. And then end of day, it's 5 cents worse. All right, or 7 cents worse. Doesn't matter. 10 cents worse. Doesn't matter. You'll get the next one or the one after that. It really will work out 50-50. But there's no way to control for that. I would have to know the future to know that. And I don't, unfortunately. It's just take the trades on the same day, open and close, and whatever the prices are, that's what they are. It will all work out for all of us. Kind of a long-term law of large numbers kind of thing, where sometimes you notice, oh, well, that was really bad. But you may not notice all the other times it worked in your favor. Just emotionally, investors tend to do that, where we will remember all the things that went against us, but sometimes we kind of gloss over all the times that it was advantageous. So on a long term, won't matter. But same day, take the trades, even if the prices are, fairly different throughout the day. Okay, that was that one. I have to kind of go back, because when people ask two, it's fine if you ask two. It just means that I have to be careful not to skip anyone's. What does this mean? Okay. Could you outline easiest of your strats to follow and use on one brokerage and one IRA account? Well, let me just open up the daily email. One of the ways, easiest, what is easiest? It's hard to quantify what that even means. Does easiest mean the least problematic for regulations? Does easiest mean the lowest trade frequency? Does easiest mean the lowest commission cost? It could mean a number of things, but no, that's not the one. Sorry. typically I'll have a bunch of pages loaded up here, but lately my internet is so bad that I'm worried that if I have 6 or 7 browser pages open, that it's going to actually crash things. So unfortunately, I have to open them up on the fly, and that'll cost us a little bit. But let me show you in the daily emails, not sure if you're aware of this or not, but below the strategies, sorry, I'm losing my voice here. This is terrible. Below the strategies, we've got the trade frequency of all the strategies. If you meant that what's the easiest to follow with the lowest frequency, you wouldn't want to follow just the tactical vol because that's the highest drawdown strategy we have. Well, and aggressive vol, both of those. Tactical balanced has 3.3, which is a pretty decent amount. That's per month, so it's not that difficult to follow. Defensive rotation, 2.9. So if you're talking about easiest as in just you want to kind of dip a toe and get a couple of trades, I would say you want to start with tactical balanced. And then if you expand further than that, you might go number 2, defensive rotation. And then if you add a third one, if you're comfortable with one of the 3 volatility strategies, maybe tactical volatility, just because it's the one that's been trading the longest. I kind of like it the best. But that's how I would do it. I would start with this one as the core, and then defensive rotation as a nice addition to that, and then a volatility strategy as a third addition to kind of have that potential for boosting performance. That does, of course, mean drawdowns will increase a little bit, but that's what I would say. Now, on the flip side, I can say that each one of those individual trades really only takes about, 30 seconds. So for me to follow the entire portfolio, it's probably, realistically speaking, when I take the trades, let's say there's 20 trades a month across all 5 strategies. It's 20 minutes a month of actual trading. And for me personally, I don't spend more than a minute or two in actual trading in any given day. There's really never a day where I sit in front of my computer and I have more than 5 minutes at most. If all of them are switching position on the same day, it's still only 5 minutes. So I don't know. I would say the overall portfolio is easy to follow the entire thing. But if you really did want to pick and choose, consider the balance, the core. Defensive works very well as a follow-up, not as good as a standalone, and then add a third volatility strategy. And that should be super low pressure trading. Honestly, it shouldn't take more than 10 minutes per month or something on the trading. It's really, really quite easy once you get the hang of it. I always have my calculator next to me when I'm trading. You just take your net liquidation value, divide by 5, divide that by the share count, buy the shares, move on. It's actually very, very quick. So, Is there a barometer? Sorry, I was trying to fix my voice thing there. I actually ended up closing my comment section. I think this one's next. Yes. No. It's all right. Having a rough morning, it seems. Is there a volatility barometer level for which you no longer use vol trend overlay strategies? It's not to do with the volatility barometer, but there's definitely going to be plenty of weeks where we just skip the week, because one of the most important things for taking these trades is that we have some type of net long exposure in the other strategies. If you don't have that, what ends up happening is, if you imagine when that would be, when would we not have any net long market exposure? That's probably when the barometer itself, even though it's not being used directly, let's just say over 65%. If it's over 65%, that signifies that volatility has spiked up quite a bit, which means that if the market bounces, if it has one of those days where everybody just decides to buy the dip, you can see massive vol crush, which in itself isn't that big of a deal because these are manageable positions. It's only 20% of the portfolio, and we are collecting a little bit of premium up front. So vol crush in itself isn't devastating. It might mean losses, but not crushing losses. But if there's nothing to offset it, then it can feel a lot worse than it actually is. So while there's no level, what I would say is you shouldn't expect too many trades when we're not either long stocks, or short vol is better when you get both of those at the same time, but at least some net long exposure. And then I can start to run my numbers for when the strategy should be trading and what premiums to look for and all of that stuff. So it's not actually related to the volatility barometer, but if it helps to sort of imagine it that way, I would say, yeah, above 60 to 65, you should expect fewer trades, maybe no trades. We could skip a week or two. It's no big deal. I'm essentially trying to get, subject to how good the market is and how many weeks we are net long the market, but 30 to 40 trades a year of those weekly cycles, that would be really good. Because remember, if you only get, say, 0.5% or 0.75%, if you do that 30 times a year, it really does start to add up quite a bit. But got to be careful. You want to make sure that you're not doing it when there's too much vol crush with nothing offsetting it. So the only strategy, this brings up a totally side tangent, but the only strategy we have that actually directly 100% uses the volatility barometer levels is the VB threshold. It's the only one that I've said, below 20, from 20 to 40, 40 to 60. All of the other ones, of course, it uses significant input from all of the dashboard, plus all the other metrics that I've yet to share. But the only strategy that absolutely uses just that is the VB threshold. Everything else is using sort of a individual, more optimized combination of the metrics so that there is some diversification. You don't want everything you trade based on one metric. Even though the volatility barometer is comprehensive and it's 13 or 14 different metrics, it's still not a good idea to have everything trading based off of that. So each strategy kind of has its own set of things that it's built upon, has its own goals, it has its, I don't want to just be in stocks every single time in every strategy. I want sometimes it work out so that we're in stocks, we're in bonds, and we're in cash or something else. That's only possible if they're getting their signals from different places. So vol trend does not use the barometer directly. All right. If a signal changes a strategy's position after you've sent out the daily email, will you ever send out a secondary email during the same day? No, never. We do. I get this question all the time. So essentially, I personally feel like the 1 day time frame is the most ideal way to trade, because on the longer duration, if you let something go for, say, even 2 or 3 days, it can be significantly punishing if you're in the wrong trade, especially the wrong short vol trade. For even 2 or 3 days, it can be quite punishing. But if you shorten it too much, talking about intraday now, sending out multiple signals a day, you're just introducing way too much whipsaw at that point. I could send out the email at 11, and then at 2 in the afternoon, things change. I'm supposed to send a follow-up email to change the position. How do I know that it wouldn't just recover again into the market close, or the very next day it would bounce as well? Which, to be honest, is actually quite normal, where you get a significant vol crush in 1 day or a vol spike, and then the very next day it's as if it never happened. So it would require a crystal ball, and I don't have one on an intraday level. And so I've always felt like 1 day signals are the optimal level. I input all my data in the morning, make the signal, that's what it is. If it's right, great. If it's wrong, we can switch the very next day. And so that's sort of the cycle that I go by personally. So there will never be a follow-up, even if something happens at 2 in the afternoon, volatility spikes, and we just hold that position, wait till the next morning, check the signals at that point, and we can rotate out in safety the very next day. So it's not going to be too punishing to get those wrong. But it's just way too common to do those little corrections and then realize, wow, I should have just kept the original one. I consider it about 50-50. There's really no point in making those guesses. I think 1 day time frame is just perfect. Mark asks, in a previous live stream, you mentioned that you optimize your strategy for trade frequency. I imagine you set out how often in a 12-month period you'd like to be allocated to risk assets, 70%. Then use your metrics to work out when are the best times to be allocated to risky assets. Is this broadly correct? Yes. Yes, that'll get you a good start. I mean, as far as trying to reverse engineer what I'm doing, that might be a pretty good start. Yeah. Yeah. Pretty astute of you to notice that. But yeah, that's the benefit of, because really, if you're trying to optimize for performance, what inevitably ends up happening is people make the very quick realization once they take their strategy live that tomorrow isn't behaving the same as yesterday. This is obviously a very big problem for traders, and one of the reasons why nearly all backtests that look incredible on paper, and they're real, I mean, it's based, I'm not saying on paper like it's fake, it's a real backtest. It's just we have no reason to expect that the future 10 years will play out just like the previous ones did. So if you're optimizing for performance, you're almost certainly going to be disappointed when, even if the market is similar, talking about, okay, this strategy does well in good periods, and I have to figure out how to avoid stuff like the financial crisis, for example. Okay, great. We'll start out with that. We'll avoid the financial crisis. Well, the next crisis, the European debt crisis, was totally different than that one. It might sound the same because everybody was disappointed in the results, but in the end, it played out in a totally different way. The metrics are all different. So if you're optimizing to avoid certain past stuff and get into certain things that would have been really good, those won't repeat again. So yeah, backtests fail all the time. And so what my essential thing is, there's several ways you can do it, but one of them that makes sense, and it's what Mark's getting at here, is that, well, what if we say that, okay, I'm comfortable holding stocks in any year 60% of the time. I don't care if it's, 2015 where stocks didn't do very well at all. It was actually a losing year for the stock market, or 2020 when stocks were flat. I'll still hold stocks 60% of that year. And in a really good year, 2019, 2013, I'm not going to hold stocks, or I'm comfortable holding only 60. If you do that, yeah, you're probably going to miss some periods in the good year. You might take a little bit too many trades in the bad year, but that is a far better way to go about dividing up when you want to be allocated and when you don't. Of course, that's just the first step in a long process of doing this, but yeah, it's a pretty good place to start, right? If you optimize for performance, the markets in the next 10 years, just even if the numbers are the same, even if the annual return of the S&P is exactly the same for some reason, it's still not going to play out the same way. So, yeah, we have 8 accounts because of tax shelters in Canada. Yeah, so you've got your individual RRSP for 2 people. That's why I said, I can understand for an individual person, what they typically start to do is 1 RRSP or IRA if you're American. That's where, but you can't fund it very much money, right? There's limits to how much you can do, and hopefully you've gotten yourself a good income and you can actually add far more than you're allowed to in these accounts. So then, of course, some people, the first thing you would do is the tax sheltered accounts, and then after that, you would do in Canada your TSFA account. That's actually probably what you do first because you can trade it in and out and there's really no penalties. But at some point, you're going to get to that third one where you're just going to have a regular margin account. So that would be 3 that I can imagine some people might have. And then maybe an education account or some type of other additional thing, and then double that with 2 people. Yeah, you might have 8 accounts. So makes sense. But of course, efficiency is important as well. And I can't give out personalized investment advice, but you'd probably want to simplify it as far down as you can. And then from there, you do what you have to do. Take advantage of the free money when they're available, like 401ks in the US. Shouldn't turn down free money if your employer is going to match. Those accounts are very limited in what you can do with them, and the rate of return that you can expect within the strict regulatory environment of a 401k, probably shouldn't expect a very good rate of return. But on the flip side, you have to factor in that there could be employer matching, and then factor in that money. You'd have to compare, would I be better off trading anything I want in a total normal margin account, paying the taxes as I go, or would I be better off getting a lower rate of return due to all the layers of restrictions, but save money on taxes, save money on efficiency, maybe get employer matching? You have to factor all of these things in. So for me personally, one thing, I'm Canadian citizen. I'm not a Canadian resident. But even if I was, I wouldn't personally be using RRSP accounts. I would do my TSFA, and then I would do just a standard margin account. I'd just pay my taxes as I go. Because for me personally, I just like to be able to trade whatever I want. And I've accounted for the fact that, yes, it will be less efficient. There will be tax drains here and there, but that rate of return will be better than what I'm allowed to do within all the restrictions. So it'll be different for everybody. But if you've got your 8 and you're comfortable with 8 and you can manage that, then yeah, it is what it is. That was just sort of a backhanded comment. I wasn't being serious there. There's no possible way somebody could reverse engineer my work. I was just kidding. I'm always here to help. Anybody who wants to get ahead in their own trading, I'm totally here to help anybody do that. I think what I've built, I mean, it's taken so many years and it's so layered at this point that I'm not at all worried anybody's going to be able to duplicate it. But you can use it as sort of a starting point and try to build your own. Some people follow me. They're here for the long haul. They're here for 30 years. They just think, well, maybe I like this guy and I want to follow his portfolio. And they're here for 20, 30 years. That's great. There are other people who are just here for 6 months or a year, and they're just going to learn what they can and then take the reins of their own investing later on. Whatever you're here for, I will help as best I can. I'll go right up to the line of proprietary information. And of course, that's where I'd have to stop. But I don't mind getting pretty close to that line where I'm sharing quite a bit so that it'll help people build their own, trade their own. Yeah. And I know you're one of them for sure, Mark. You're a lot of questions, a lot of emails, a lot of work on your own as well. So I was kidding. I have to find part 1 of this. Forgive me, but the only other question I see from you was this. There's a lot of chop, as you say, and at least my software doesn't show any more comments from you until this one. So drops when leveraged are not fun. Well, that's true. Drawdowns are larger. Definitely spot gamma calculated levels are interesting. Below their recent vol trigger of SPY 390 have gotten a lot more interesting below that level. Well, I think you're talking to the wrong person about that, because I don't happen to believe, or at least what I should say is, I've not seen any actual evidence that trading based on gamma exposure is beneficial at all. So I would be more than happy to listen to somebody who presents me with some data. But it seems to me, and I know on Twitter it's such a huge deal. People talk about gamma risk, the gamma break points, and below 390. Look at all the Vega the market makers are carrying. I've not seen any actual evidence of, okay, below this line, it works like this, and I can show you that from the past. It's always, and maybe I'm following the wrong people. I tend to follow the most popular sort of gamma exposure people. I've even emailed them privately. I said, look, I'm interested in what you're saying, but can you show me something, right? Some quantifiable reason why I would believe that a person should actually allocate cash based on that. And you get nothing in return. There's really, really nothing. They typically give you theory. They say, well, here's why it would work. It's because if the gamma risk is this high, or if the Vega exposure, market makers have to do this. And they can explain it on a macro scale. I'm just looking for some numbers. Just show me something, right? A track record or a back test. Show me something. And to date, I've been asking for many years on many, many experts in that field. And I've got to tell you, not a single time anybody's ever actually shown me anything that would make me think it's anything beyond theory. So, yeah, I don't even know if that was part of your question, but you said, the gamma below 390. I know, but I certainly wouldn't bet a single penny of my money on those types of things. I haven't been trading VXX options for long. To me, the spreads look quite high at the moment of the underlying. 5 of 1170. It's probably because you're looking at it after hours. I don't think they're anywhere close to that big, are they? I guess it depends which strike you're looking at, but let me open up my Thinkorswim. Another thing you have to remember too is that the bid-ask spread isn't necessarily a prohibitive thing. If you see a fairly large spread, that doesn't stop you from getting the mid prices. That's why I always say you really should target that mid price. Even if it's a wider bid-ask spread, that doesn't mean it's going to be any less efficient than something like the SPY, which is just tight 1 penny on either side. If you get the mid price, then nothing matters. So I would say, unless you actually have experience where you're seeing the mid price and you're not getting anywhere close to it, at that point, maybe you want to be concerned a little bit. But no, for VXX, I've always found it to be extremely liquid and very tradable on pretty much any time frame and any strike price. I mean, I don't go out to the super extreme deltas, but anything sort of even remotely close to the money should be fine. If you look after hours, yeah, sometimes you see that the bid-ask widen. But say, for example, the trade that we took, the 1150 for next week, it currently says 26.29. I would imagine if I wanted to take a trade at this, I would easily get the mid price. I wouldn't have a problem taking that trade with that market. So I think there's a difference there between the bid-ask spread that you see and the actual effective mid price that you're getting. You can track them. I always say that to people, that if you're concerned about liquidity or if you're concerned about the bid-ask spreads, take several trades, maybe paper trade if you want, or just following our strategies, and record the actual price that you traded it in the moment that you traded and see how close you got to that. And then you can check in a couple of months, how close was I? How inefficient was it? You may realize that, well, it's actually just a wider bid-ask spread, but I'm still getting efficient fills. That's what I do. And sorry, my phone is just going crazy here. I don't get many calls, so it's a little bit odd. Yeah, I've not noticed anything. All the ETFs we trade, all the option trades we take, I've not had any problems getting the right near the bid-ask or right near the mid price. Do you share any spreadsheet templates we can use to track our own VTS performance? I have multiple accounts and some of them are only partially allocated to VTS. So I can't just track account NLV. Not sure what that means. Probably missing the acronym there. I've not prepared anything because mine are pretty straightforward and simple. So first of all, you'd have to decide, well, why do you have to track it at all? If it's important to you to track it, you do have an account that you don't have a choice. It tracks every trade that you make. So I would imagine that that's good enough for 99% of people out there. If you happen to just want to see stuff, then you can track it on a spreadsheet. But for me, mine are pretty simple. Like it's just, I just make them in Excel based on what I want in my trades. So for example, this is my vol trend overlay. See if I'm on screen share. There, go on the screen share. I just decide, well, what do I want to track personally, right? So the ticker, the net liquidation of the portfolio, because for this strategy specifically, the profit is being calculated based on the overall net liquidation of the entire portfolio, because it's an overlay. It's not a portion of the funds, it's everything. So I have to know, what was the account size when I actually opened the trade. And so that this account is this account, right? And so I have to know what that number is. So I record that. I like to know what the actual price of the VXX was the moment I opened my trade, right? So this one, it was at 1833 and I sold the 1550 strike. There's just a few other things. Of course, the open premium that I got, the number of contracts I took, close date, close premium, and then your just general profit. It's actually very easy. If you wanted more things than this, then you just add more columns. But like I said, you've got a software that tracks everything for you, whether you want it or not. And depending on what broker you use, some of them are really good, and they'll print out already prepared forms that will show you a lot of detail about what you're doing. So I would say just very simple Excel spreadsheets, maybe 5 or 6 cells. Start with that. And then if you think, well, in the future, I might want to know something else. What was the volatility level at the time I opened my trade? Add another column, record the volatility barometer on that day, record the VIX on that day. Maybe someday in the future, you can look back and it'll be useful. But beyond that, I don't really record more than what you just saw. Not really important to me. I just, for future reference and strategy building, I do include things like, what the volatility barometer was and all that stuff. I have separate columns that it's just for my personal interest, right? Good for fine-tuning trading strategies. But Excel does everything. I'm really old school. I don't have apps or anything, the new programs. Everything I do is in Excel. And so to answer your question, you said, do I offer any? Not really, because they're just so basic. If you wanted me to put something together, it would look exactly like what you just saw, but you could do that yourself in 5 minutes. So it kind of, why bother wasting the time when it's not gonna wow anybody? Oh, his Excel spreadsheet's so amazing. We can track everything. It's just, think of what you want to track, open a column, label it, and track those things. It's up to you. Okay. Taking account volatility strategies will not outperform as high as in previous years. What is the reasonable return for the total of the strategies that you expect for the next few years? Well, that would require a crystal ball. So, it's always hard to say because I know what my strategies do and when they perform well and when they don't. And of course, not everything works in all environments. And in the last few years, it's just not been ideal for what I do. And I think it's completely fine to say that we have strategies that are more trend following. And I think that's the best way to invest. That does mean that there are times when they will just not be in their perfect environment. So certainly the volatility strategies are the most out of their own environment right now. We've got the tactical balance, defensive rotation. They're doing fine. They're based on historical pricing. Everything's fine, even maybe a little bit better in some cases. But volatility is really the one that's quite out there. And I've actually shown why that is. It's not necessarily, the strategy itself is still substantially outperforming based on the benchmark that it's trying to trade. Short VXX, a rolling short VXX position, was up over 2,000% from 2011 to the end of 2017. So, I more than doubled that. Drawdowns were less than half of that, so it crushed the benchmark. From 2018 to current, it's down 45% per year. So we're trying to take something that is down on a rolling daily rebalanced level of, it's down a lot, right? 43 or something percent per year, trying to take that and make it profitable. Obviously, it's not going to be as good as the previous years. But the other strategies, tactical balance, defensive rotation, there's less reason that those would significantly decouple because the benchmarks for those, stocks, bonds, gold, are sort of within striking distance of a normal level, right? We're at all-time highs right now in the stock market. So, I don't know. Tough question to answer. If I had to, gun to my head, reasonable return, total portfolio solution, it's earned 20% over the last 9 years since I launched live. So those are totally live signals that went out to all the community. I think it'd be reasonable to assume the 20 would go down to 15-ish, 12 to 18 to do a sort of a range, 12 to 18 for the unleveraged, and then say, I don't know, 15 to 25 for the unleveraged. But again, I mean, this is unimportant because, as you can see, I'm guessing, right? I don't know what the future holds. I think if the markets get back to more normal, what I would consider normal, then there's no reason why the performance wouldn't be like it was in the past. If it doesn't, and this continues, then this continues, right? Last year, the total portfolio made 14.6 or something, and the leveraged made 28. That might be where we're at going forward. If the markets are not going to cooperate like they have for 2011 to 2017, what are we going to do? It's not magic. We can't take something that's negative and turn it into 30% a year. So yeah, one of them made almost 15, one of them made almost 30. It's kind of normal. I would say that's within the ballpark of what people should expect long term until something changes, which it does all the time. So, oh, interesting. Never seen it written out like that. I always say net liq or net liquidation value. Yeah, NLV. Yeah, I should have known that. Do you think TLT will ever go back to all-time high if the interest rates go down anytime soon? I happen to retain some TLT, not exactly following your advice. Should I write covered calls? Okay, there's a lot of questions in there. So first of all, do I think TLT will go back to an all-time high? For that, I personally don't care because I'm not a buy and hold investor. I don't need something to go to an all-time high to be able to take out a little bit of profit from it. So for example, I did a full video, I think it was about 20 minutes long, showing the performance of just our TLT positions and just our IEF positions. And even though both of those are down, buy and hold, within my strategies, they're both up. They're both still mathematically profitable for us. So back to all-time highs, I don't know. It would require interest rates to start going down again. Is that going to happen? I don't think there's much appetite for interest rates to change in either direction right now, to be honest. I think probably down is more likely than up, but I think as far as actual policy, they're going to try to tread water here for quite a number of years, if possible. So who knows where TLT goes? If you're buying and holding it, it's not great. It's not I can't tell anybody what to do or what not to do, but it's certainly not somewhere that I would park money in, if that's what you're asking. And then I guess the last part of that, should you write covered calls? That's another interesting thing that it does depend on your long-term goals. So for me personally, writing covered calls is nearly always a bad idea. The only time I ever do it is if I'm actually trying to get rid of the position. If you're trying to just get paid on your way out the door, then selling covered calls is fine because you can sell very aggressively, like right at the money or sometimes even in the money, and just get paid a little bit of premium as your shares get taken from you. And then you're back to cash and you can do what you want. So for my Wheel of Fun, for example, it's an option strategy that I have. We sell the puts, collect a little bit of premium. If we get assigned the shares, no problem. We sell covered calls, but those are being sold very aggressively with the purpose of getting rid of them. If you're a buy and hold investor and you don't want to lose your TLT shares, selling covered calls is a bad idea because you're not reducing your risk hardly at all by selling covered calls. If it goes down, you're still subject to nearly all of that, minus the tiny premium that you collect. So there's a tiny percentage of insulation there, but really you're not reducing your risk, but you are significantly capping your gains. So that's never a good trade-off. If you happen to go into a period where TLT does bounce and has a nice 10% run, you're going to lose your shares. So if that's not part of your strategy, overtly trying to lose your shares, then don't sell something that might cause you to lose your shares, especially for tiny premium, because you're really not going to make much selling covered calls. So it's just a bad idea as far as risk reward profiles. If you're going to be buying and holding something, if you're going to dedicate capital and actually hold something through good and bad, you certainly don't want to cap your gains because you need those gains to cover for all the times that it's going to draw down on you. Most things do. Don't cap your gains and then be subject to all the losses still. So my only, if you just want to get out of the position, yeah, covered calls are a pretty decent way to do it. All other situations, it's probably a bad risk reward profile. Okay. I've only been trading VTS since this year. So I assume January 1st, we'll just say. So buying at the top and been getting hammered on the drops when leveraged has not been fun. So I don't know the current numbers. The leverage total portfolio as of February was down about 5.2%, I think. So this sort of ties in, and I guess I'm reading between the lines a little bit on the language, but this sort of ties into the part I said above to the first person who said, can I use triple leverage? Using triple leverage will cause significant drawdowns eventually. Maybe not right away, but eventually you'll get hit with something. And most people overestimate their risk tolerance. So I've actually had people this year who follow the VTS strategies who say some things similar to this. Things that sound like they're uncomfortable with the drawdown, which is fine. If you're uncomfortable with a 5% drawdown, that's totally fine. It's your risk tolerance, not mine. For me, this is just part of a long-term process. I've had 5% drawdowns 5 or 6 times in the last 9 years. So I'm not uncomfortable at all right now. But I do notice some people are. So just remember that there is a difference between saying, oh, 5%, that's nothing, to when it actually happens, you feel like, well, I'm down 5%. As he said, I'm getting hammered. Hammered? Really? Because not really hammered. The market's at all-time highs, and I haven't checked what the numbers are, but we're not that far off all-time highs in our portfolio. So I think it's unfortunate that you followed. January 2021 was, I think, the 3rd or 4th worst loss that I've taken in the last 9 years. So if you literally started, say, end of December and you got hit the very first month for that, yes, that definitely sucks. And sorry about the terrible timing for you. But other than that, there isn't really a whole lot of getting hammered being done right now. I don't want to be that guy that's trying to talk people into stuff, but I mean, this is updated as of February. I don't think there's really any cause for concern personally. And again, I'm not trying to make excuses for things. This is the leveraged portfolio. This is the one that's hammering you. I'm not sure I'm seeing where we're getting hammered. Not to nitpick too much. I realize this is a semantics thing. I'm just reading a question and trying to interpret the general language there. But yeah. There's no way to say these types of things, and you'll have to forgive me. I just have to be able to speak freely, right? But there's no way to... Let me cancel that. I shouldn't do that. There's no way to talk without sometimes it sounds like it's an excuse, and I really don't want to be that guy. I want to be able to speak freely and be sensitive to people's, how they feel about things. But at the same time, sometimes you just have to state things obviously. And if people are going to be uncomfortable with investing when they hit a 5% drawdown, I really don't think investing is even possible, because there's literally no asset class in the world, including even short-term treasuries, that doesn't draw down way more than 5%. Way more than 5%. There's literally nothing on the planet that you could ever do that you won't at some point suffer 10, 15, 20% drawdowns. And that's safe. Most investors, they're 1 year removed from suffering a 30 to 40% drawdown. That was just last year. Bonds didn't help them. Gold didn't help them. Utilities didn't save them. They lost 40% of their net worth just a year ago. So for us to go through last year suffering no more than a 2% drawdown, and then of course this year we get hit with a 5%er, perspective, right? I mean, you really do have to have some perspective if you want to stay the course. If you're looking for sort of following what's working in the moment, you can certainly find plenty of things that didn't draw down 5% in January, like I did. But let's be fair, I only drew down 0.6% last year when pretty much the whole investing world drew down 30 to 40. So again, not making excuses, but try to look at the big picture sometimes and see that, we're just trying to move the chains forward here. We're not trying to, turn underlines into 50% annual returns. It's not magic, but as long as I can see that sort of my little slips here and there along the way, you get periods where it's kind of more flat drawdowns, real explosive growth, flat, explosive growth, flat. It's kind of fine as long as I'm moving the chains forward. In my opinion, that's kind of what I'm looking for. The strategy made 28.5% last year. It's down a few percent this year. Just mentally, just perspective, right? Don't talk about how you're getting hammered. Just say, because you want to reserve that for the times that you actually are in a drawdown that requires a decision to be made. Right now, I don't think that, I can't say what you should do, but I'm nowhere near the time when I should be making decisions about, hey, should I change course here? Not even close. You want to reserve that language and your emotional capital for the times when you really are in a significant problem and you have to fix it. You don't want to turn every problem into that day, because you just end up spinning your wheels. That's how investors invest for 30 years with 5 different advisors and never make any progress. That's why. It's because controlling emotions and managing emotional capital is something they didn't really focus on. So, long rant there, and then several other follow-ups. So let me do this one, interrupt it for a few seconds, and then I'll get back. There's 4 or 5 looking there. All right, it seems like the best times to take vol trend trades are the days when there is all-time low on VXX and nice rally in equities, and more days in a row, the higher the chance to get a few days sideways. I think more or less that's accurate. So if you were to look at best entry points for vol trend, yeah, like what this person is saying is basically, if you see massive crush here, taking a trade now, it doesn't mean that there couldn't be another 2-week trend of just insane vol crush. That could happen again. We could get that for a month straight. But surely it's more likely that we're going to get some type of bottoming period or a few days of, doesn't even have to go up. We don't need a spike, just something flat-ish. So yes, you're absolutely right that the most dangerous times to be taking vol trend trades are right after volatility has spiked. That's clearly the most dangerous time. Whenever you get these spikes, it's true that it could continue to spike, and then you maybe sell something here and it's an easy win. But the risk reward of doing that is that you can lose quite a bit on the downside. If the market does the old buy the dip on you and they pull the rug out and the VXX starts crashing again, these are the times when you really do want to kind of sit on your hands, and especially because the portfolio is not going to be allocated at those times, you really don't want to get too aggressive there. You could try to just sell way, way out of the money. I think I showed it recently here. Like in January, on the 4th of January, it was at 1833. I sold a 1550 for 5 cents. You can kind of do things like this. These are all winning trades. And you can see I'm going significantly out of the money compared to the one we did just recently, where it wasn't really that far out of the money and we sold the 1150. We have to do that now because volatility has crushed so far that, I would totally agree with that. That's not exactly how I'm selecting trades. That's quite simple. But as an entry level, that's a pretty good understanding that it's just the more it goes down, the less and less likely it is that it will continue crushing without a little bit of interruption, right? That's just investor psychology. Nothing goes up or down forever. And when something starts to go, it's one of those things, it decouples from actual raw math, right? If you're flipping coins and somebody thinks, well, I've got 6 heads in a row, surely the odds of a tails is bigger. Sorry, it's not. It's still going to be 50-50 on that coin flip. Investing is not a coin flip. There is emotion involved. And when you see something work 5 weeks in a row, it is less likely that it'll continue working on week 6. It's not mathematical coin flipping there. There is diminishing returns of success that investors notice, and they start adapting their buying behavior based on that. So yeah, I think that's a fair assessment. Again, I don't base that on how I take my trades. I'm measuring the portfolio allocation, beta to the S&P, trying to get everything calibrated correctly. But that'll get you started, and that'll get you into more good trades and keep you out of more bad trades. If it's week 1 and you have not seen any vol crush yet, week 1, you might want to be more conservative. If it happens 2 weeks in a row, still be conservative. Vol crush can happen for 3-4 weeks. If you're on week 4 and it's just been VXX down every week, you can start to get more aggressive on those sales. Definitely. Okay, I see Jeff's question down below, but there's about 6 here, so let me read into where he's going here. There's a lot of them. It's hard to keep up because, again, my comments are kind of skippy. I'm not seeing everything. Trying to reduce the more violent drops. I move from leverage to unleveraged once below vol trigger. I cannot post URL. I'll drop an email. Yeah, this might be one of those cases where you just want to email me. It seems like you've got something here that you need solved, and I definitely want to help. It's just hard live, real time to go through all this. My overlay. So that's totally possible. So this part here about got overly aggressive with the overlay. Yeah, it's going to be everyone's temptation, and that's why I'm going to be very direct in telling people that this is supposed to be ultra conservative. You're not supposed to just because you have leverage to use doesn't mean you go out and you use it all. New trading psychology. Sorry, I'm just trying to catch up as best I can here. Spot little pieces, and yeah, you have to risk money to make money. That's definitely true. If you want to make a 10% return, you got to risk losing a significant part. And if you actually think about it, the S&P 500 has returned, let's say in the last 20 years, I'm guessing 6% a year, annualized over the last 20 years. What are the drawdowns? Well, 56% in the financial crisis, 34% COVID, 22% European debt or 2015, 18.8% or something European debt crisis. We could go on and on. 40 something percent during the dot-com bust. You're talking about suffering insane drawdowns, potentially 5 or 6 times larger than the S&P 500 actually returns. So if you're trying to make 10% return, VTS is a little bit unique in the sense that my rate of return annualized is way higher than the actual drawdowns are. So the maximum drawdown of the total portfolio is 7.7, only happened once. Next lowest is 5.1 or something, but the annual return is 4 times larger than that. So that's actually quite rare. And I think people get lulled to sleep in thinking that somehow that's normal. It's really not. So I do on these streams and in my emails and my videos, I do always like to give people realistic expectations and communicating that drawdowns happen and they are uncomfortable and they can get much larger than 5%, I think is important. Whether I actually hit a 5% greater or not, I don't know. Maybe I can navigate just like the last 9 years and avoid all of them. That'd be awesome. But I do want to prepare people that it would not be abnormal to see a 10 or a 15% drawdown portfolio wide. That would still be well within the norms. So obviously I've structured everything in my investing to make sure that doesn't happen. But yeah, realistic expectations is super important. I would say email me this whole thing. Ask me anything you want, of course. I'll work through all of this with you and we'll get to the bottom of all of these things. Some doubts, some things with VTS, some things outside VTS. Yeah, this is definitely more suitable for an email. So sorry about that. I can't get them all on the live. Jeff asks, I had a question at 12:40 timestamp. I didn't see any. I would have known. If your name popped up with a question, I would have seen it. So no, I don't have it. Nope. Sorry. I actually don't see a difference between when I click live chat and when I click top chat. So if possible, ask it again. We've still got some time here. 1:08. We're getting there. Let's ask the question again, and we'll see what you got. Okay, I'll just go back one more. Something caught my eye. It might be interesting to just rant on about. I like my rants. Just comparing how many hours working in my current day job to the amount of days I have to work that was lost, but also on the flip side, gained on the upside. What do I think of that statement? On the one, I like this. I'll have to give it more thought, but when you're an entrepreneur, one of the best things that you can do for yourself is start seeing income through the lens of time. So I do like what you're getting at there, that when you're analyzing money, to see it as time spent. I think it'll serve you well in nearly all instances in your life. Like everything you do, from, you get people who clean their own house, right? Well, if you have the type of job, say you run a business or something, and I'll use me personally, there's never enough hours in the day for me. There's always more work than I have hours in the day. So everything in my life, literally everything that I do, is costing me money. So if I can outsource something and save that time and put that into my business, that is directly linked to my income. So I always put everything in the context of time, right? So I really like that. It's just that when you transfer it over into trading, I'm not sure that's going to be a mentally beneficial for you, because they're so different. Working hours compared to the unpredictable nature of when your investment returns come in. Like, say, for example, the reason I like it as an entrepreneur is we can put reasonable expectations on how much work we do day to day and how much income that will lead to. And it's fairly consistent, right? It might fluctuate a little bit, but it's consistent. With trading, you really can go through extended periods where you've made nothing or you've lost stuff, and then just out of nowhere, the markets just kind of click and they cooperate for a couple of months and you make all your money. So turning everything into time from a trading perspective, when on the other side of that equation is so unpredictable, I'm not sure if that's helpful. But overall, I like the idea of transferring or viewing things through the lens of how long you have to work to make that money, because it'll put a lot of things in your life in perspective. I know for me personally, before I was an entrepreneur, I would always look at people who had a maid, for example, somebody who cleans their house, a driver. If you live in New York City and you're a real estate agent, you have a driver. I always used to look at that as so frivolous and wasteful. Like, look at this guy. He's got a driver. What, you can't just get behind the wheel and drive your own car? But you start to equate it to, okay, well, if that person is in my position that I'm in now, I have more work than hours in the day. Then if I can sit in the back seat of a car and answer an hour of emails or get on a couple of calls with some clients, I'm saving more money than that driver costs. So the only people that look at those types of frivolous expenditures, or a chef that cooks your own meals, what, you can't cook 20 minutes a day? Come on, who doesn't have 20 minutes? Well, I don't have 20 minutes. I have more work than hours in the day. So I don't have a personal chef, but I've often considered it. If I stayed in the same city long enough, I probably would. I like to walk. It's part of my day, but I could get a driver. I could get a maid. So, and the reason that's happening isn't because it's pretentious and, oh, look at this person, they're so lazy. It's because that person's viewing it through the lens of time and work, how long it takes to actually make that money. So I like that overall. It will really put things in perspective. The things that you do day to day, sometimes it just feels like, wow, I've been wasting so much of my potential on things that I thought they were just little things. Like, why can't I just take a break for an hour and clean the house? Well, that time is more valuable doing other things. So, But trading, too unpredictable. I wouldn't go down that road. Okay, what is this one? Nearing the end of the 2-week trial. I want to buy an annual, but was waiting for the updated discounted link. Should I just use the website annual link? No, I'm not going to take you off the, I haven't looked at the name yet, but you're not going to be taken off the email list when your free trial ends. Typically, I keep people on for a little while just in case they were in VTS trades. I want them to be able to cycle out of the trades at the normal speed that I do. I don't just want to, your trial ends and boom, you're gone. Even when people unsubscribe, they've been paying for a while and they unsubscribe, I still keep them on the list for a little while just to make sure that they have time to find something that's more suitable. Maybe what I do just doesn't match, your goals. That's fine. So you're not going to be removed. So what I would say is don't sign up for the annual link. I will be emailing out shortly, probably within a week or two, the annual links, and it will be cheaper than the one on the website. So if you did sign up on the website, you would just get a refund in 2 weeks anyway. So as far as efficiency goes, you could do either. You can just sit, do nothing, let your free trial expire, and you'll still see the emails. And then in the next week or two, you'll see an email from me saying, if you'd like to sign up for the annual, here it is. Yeah, that's how I would do it. Just sit tight, let it expire. I'll get to those emails soon. It's not super high priority. I always prioritize everything portfolio related first, then customer service type things, answering emails, that's all second. And then kind of down the list further is managing the actual business. So I'll get to that. It won't be too long. I think we're all tired. Yeah, it's Saturday. Get out there, do something fun. You don't need to be here for this long. If you have questions, that's what the office hours are for. Otherwise, it's Saturday. Yeah, get out there and go golfing. I haven't golfed in ages. Funny, Vanessa. So I've been with Vanessa for 11 years now. And for the first 10 years, she never touched a golf club. I'm a former professional golfer. Golf has sort of been a major part of my life. She's never touched a golf club. And for me, she's a yoga instructor. I haven't done yoga in the last 10 years either. I did yoga to meet her because she was the yoga teacher at the gym that I was at, and I'd see her coming and going from her classes, and I thought, well, I'm not exactly the just go up to someone and just ask them out type of person. So I thought, I'd duck in for a few of her yoga classes, but 10 years, no yoga for me either. So I understand, but she hasn't touched a golf club since. And in the last 5 months, just before I left, I kind of got her interested in golf, and she's played 18 times, 18 rounds of full rounds, 18 holes in the heat. Amazing. I've played 0. So the golfer in my family now is not me, it seems. So I should probably fix that. Maybe I should go today. What's the temperature today? It's 9 degrees Celsius. No thanks. I'm a fair weather golfer these days. It's not my job anymore, so I'm not going unless it's sunny and warm. And Vanessa's actually pretty good. She's made 2 birdies already, which is just, most beginner golfers, they'll go years without making a birdie, but she drove a par 5 in 2. I didn't believe her because I didn't see the shot, and my other friend was playing, and he's like, she just hit it on the green in 2, right? And I'm like, no, come on, you saw something wrong. And then we got up there. She was 20 feet from the hole for eagle. She almost made it. It just burned the lip of the cup for an eagle. A 45 handicapper nearly made an actual eagle and just tapped it in for birdie, just like it was nothing. So she's pretty good. Quite impressed. I'm going to have to practice to regain my title as the golfer in the family. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.